Even though we are hovering at record highs, the bears haven't left Wall Street just yet. A recent Bank of America survey shows global fund managers are feeling the most bearish since the financial crisis. But our next guest says that's actually a good thing for the market. Let's bring in Ann Bartels, the head of ETF strategy at Bank of America Merrill Lynch. Welcome back.
Thank you for having me.
Too many bears?
Yeah, I mean, we're all shocked because the level of bearishness we can't find until, as you said, back to the financial crisis. And we're nothing like the financial crisis. There's a lot of noise, obviously, going on here, over in Europe, but the extreme just seems way too much. So from a contrarian basis, that leaves a lot of dry powder as a potential to come into the market. So we're actually calling for a strong summer rally. We have been. We continue to say that the S&P can rally up towards 3,000.
What do you make of the fact that, staple stocks have been doing well, gold's been doing well, bonds have been doing well? You have to get a rotation out of some of those more defensive areas and into some offense?
I think what you pointed out
for your scenario to happen?
Yeah, I love that you pointed that out because it really doesn't make sense, right? How could staples be making a new high, bonds making recent new lows in yields, and gold is breaking out, but the dollar's also weakening? Part of that, to me, sounds like there are some concerns out there for deflation. A deflationary trade would be gold, bonds, and of course cash. I'm not convinced that the move in gold is really defense, more of a concern about the bear market. I think it's more of a deflationary trade. As the markets have rallied, the yield on the S&P is around 2%. The yield around 10-year treasuries is 2%. Our clients still need income. And part, I think, of what's going on in consumer staples is that sector now has good yield. So I'm not sure, again, it's a defensive play. I think that's an income play, and I think there's a deflationary trade, meaning that the market is very confused on where to be. Mm-hmm. And again, that gets back to our survey that there's so much bearishness out there. And we don't see a recession. Yes, we see a slowdown here domestically. We see a slowdown globally, but we're still looking for 3% global GDP growth. Is earnings slowing down? Yes, but they're not negative. So we can't come up with a reason for a recession or for going into a bear market. And the argument that I made is you just had the bear market, and we don't see clients talking about this at all. You had a bear market in the fourth quarter. And when I talked to our technical analyst, Steve Sutmeyer, I said, has there ever been a time we had two bear markets back to back? And he came back, kind of, clarified it and said, never before in a secular bull market have we had two bear markets back to back. And I trade under Bob Farrell for a period of time. And what Bob used to always say is investors always invested based on the last cycle. And I think that's really what's relevant to our survey. They're investing based on us still being in a financial crisis. Meanwhile, we've completely moved out of that. The interesting part is, as Bob said, by the time they figure it all out, it'll be the end of the cycle. And we're nowhere near that.
But Marianne, so when you say financial crisis, do you mean 2008, 2009, or do you actually mean December?
No,
Is the mindset, because first of all, anyone that went through 08, 09, 07 through 09 basically feels like I could see this again in my lifetime, and they trade that way. And December felt like that. So I'm wondering, is that the hangover you're talking about?
Well, certainly we're not 08, 09, but the data, the data that we're quoting, that we've never seen clients this bearish, goes all the way back to 08, 09. Yes, I think having a bear market creates a mindset that goes back to very similar to 2008 and 2009. When we talk to our financial advisors, even though the market year to date recently was up 17%, clients are not behaving as if the market is up 17%. They're getting a lot of calls, concerns, and worries, obviously China, then Iran.
So your price target for the S&P, or your target's 2,900?
For the year end. So we're not seeing...
How does that work out, though? If you expect
a lot of volatility.
You think we're going to have a ramp up and then...
and then a sell-off.
And the sell-off is based on what?
Well, I'll let you know. But basically, I'll let you know. Well, why the volatility? Because we're only looking for...
You're looking for a sell-off, but you don't know what's going to cause a sell-off?
The exact reason why it sells off, the reason why we're not pricing the market higher, is we're only looking for single-digit earnings growth rate. So we've been forecasting a slowdown in the earnings growth rate. So with the slowdown in the earnings growth rate, we're not sure how much the PE multiple can expand. Now, if the 10-year Treasury yield keeps falling, yes, you might wind up with Tina. There is no alternative, and people just chase stocks and expand the multiple. We're just not comfortable doing that. So we think the gains are modest with a lot of volatility.
Gotcha. BK?
Yeah, so I'm curious how much the demographics play in this, because I got to think that most of the people you're surveying are approaching retirement, baby boomers. They need that income. So it's less about a play on the market or the economy and more about the Federal Reserve is going to raise my cost of living and lower what I can earn on savings, so I have to buy staples.
So the survey that we're quoting are professional fund managers from around the world. So those are not individual investors. But individual investors, I meet them all the time. They're not generating enough income for sure. And they're trying to find ways of generating income. And generally, they take more risk in trying to find income. Staples are not considered risk. Because they're considered defensive. I'm just saying, generally, they're not considered as risky. And I looked at them, in the marketplace, there's actually some really nice yields that you can find in consumer staples. So I think that's why they're poking around in that space. Not a sector that we have overweight, though.
Mm-hmm. Marianne, good to see you. Thanks for being here. It's Ann Bartels, Bank of America, Merrill Lynch. All right, what'd you guys do today?
Well, it's interesting. Procter & Gamble quickly, Staples. Let's just talk. I know Marianne knows this, but you're talking about it. Procter & Gamble trades 23.5 times next year's numbers with maybe 11% EPS growth. Probably trades at a standard deviation or so higher than its historic multiple. I understand why people are chasing, but I just think it's wrong. So I actually get exactly what she's saying. I mean, it's not ridiculous to think the S&P could trade up to 3,000 and have a fade. I don't know what the reasons be either. I could cite 5, and probably none of them will come to fruition. I'm more cautious, though, so maybe sometimes the consensus is right.
But what's encouraging for this market is that she talked about the reach for yield, and what you're seeing is a dynamic where, first of all, if you look at high yield, we're basically back to the tights credit spreads from really the blow-off top of Jan 2018. If you look at EM duration risk, so people that want to get concerned say people have been pushing out the curve in terms of duration without getting overly technical. Basically, buying longer-term debt where you have more volatility is something that people have been doing, and something that, frankly, is where people get concerned. But the rotation in the market the last 2 days tells you people are going back to big cap tech.
I think you got to add to cyclicals. I think you got to add to your point, people got so over-levered with the defensive names or the growthy names. And I think Lennar already set the stage. It was up year to date very well. And now you saw everyone bash Lennar, bash the space, and KB has a better report. I think home builders, that's where I've been adding.
Yeah, I just think you still have to be cautious and level. Home builders, perhaps, right? There's no tariffs on home builders. Yields are low. But in general, I just don't think at the market highs, we're relatively close to the highs, with all this uncertainty out there, that you have to get over your skis and start buying everything here. So for me, I'm just in a cautious mode. Take a bit of profits off the table.